Welcome to the Financial Planning Certification Exam Lessons podcast. This is going to be a sample lesson of the full series of audio lessons which are available at the website fplessons.com. That means financialplanninglessons.com, fplessons.com. At the website, you can find the full series of audio lessons. The full series of audio lessons consists of 6 different sections. Those sections include general financial planning principles, professional conduct and regulation, insurance planning and insurance products, investment planning, tax planning, retirement savings and income planning, and finally estate planning. A total of 6 different sections. You can buy the individual sections at the website fplessons.com. All right, let's get on to this sample lesson. This is audio lessons for the Financial Planning Certification Exam, Part 5, Retirement and Income Planning.
Hello and welcome to a review of retirement planning for the Financial Planning Certification Exam. This is episode 3. I highly recommend you watch the previous 2 episodes before you hop onto this one, but without further ado, let's begin. So we had started discussing retirement plans in the previous episode, so I'm just going to continue off of that. We discussed the 401k plans already and what it means, the implications on the account and who can defer and contribute, etc. But there's also something called a solo 401k. It's also known as a uni 401k, UNI, uni 401k. So this solo 401k is not subject to coverage testing and on discrimination rules necessary for your normal 401k plan. So again, no coverage testing, no discrimination rules. Doesn't apply to a solo 401k. The plan also allows 2 different contributions. So there's the elective deferral up to $22.5K for 2023, plus the employer's contribution with a overall cap at $66,000. So we already kind of discussed this, but so just like a normal 401k, we've got our $22.5K elective deferral and then a cap of $66K total in the account for that year, or employer contribution. We also have the standard catch-up, the $7,500 and $7,500. That's, again, allowed for participants aged 50 or older. So, why is this called solo? It sounds pretty familiar to the 401k besides the testing requirements not being there. So, who is this? What are we applying this to? You and your spouse. Or, two partners in a business. Those are the people that are getting solo 401ks. So, if you and your spouse run a company together, you both get a solo 401k, or if you run your company with a partner, you also both get a solo 401k. Other employees, like part-time employees that are under 1,000 hours, do not count. It's ERISA still with the 401k, code 401k or section. ERISA has requirements, remember, for eligibility. So for part-time employees under 1,000 hours, nope, they are not included in this. All right, so Keogh retirement plans and SEPs for self-employed individuals have special rules. It's important to remember that Keoghs are not plans themselves, but rather it's an adjective, and you'll see. But I just want you to keep that in mind. Sometimes it might mislead you by just saying, a Keogh plan. Well, that's not possible. So Keoghs and SEPs for self-employed individuals, there's special rules. So normal, corporate plan limitations are 25% of the owner's compensation, 25%, to a maximum of $66K with no catch-up. But the UNA 401k, this solo 401k deferral and contribution could be $73,500 because it does have a catch-up, the $66,000 plus the $7,500. So this could be a benefit. That's a larger dollar amount. That's $7,500 more than a KEO or a SEP plan for a self-employed individual would be, or even a normal defined benefit plan, depending. So that is the appeal of a solo 401k plan. And obviously we'll get into these other plans in a second, but just keep that in mind. There's that catch-up contribution. That's the most appealing thing about the solo 401k. Moving on to stock bonus and ESOP plans. So stock bonus plans are 25% employer contributions, and employee stock ownership plans, which stands for ESOP, is also 25% employer contributions. So don't separate profit sharing with stock bonus and ESOPs. They're the same thing. Stock bonus and ESOPs are simply variations of profit sharing plans. And if you think about it, if I'm giving you, let's say, company stock, or I'm letting you kind of participate in the profits. So hopefully that helps you remember that ESOPs and stock bonus plans are profit sharing plans. I am participating in the profits. So you just think about it like that. I hope that helps. So let's talk about ESOPs, the employee stock ownership plans. So ESOPs are stock bonus plans, just to confuse you more. ESOPs are stock bonus plans that the employer can use as a sort of flow through for borrowing money from a bank or other financial institutions. So when an ESOP is used to borrow funds, it is known as a leveraged ESOP or a LESOP. Isn't that cute? All right. So again, the employer can use it as a conduit for borrowing money, and that is known as a leveraged ESOP or a LESOP. Okay, so it's used to borrow money. So how are these different from your run-of-the-mill traditional profit-sharing plans? So a stock bonus plan can invest plan assets in the employer stock. It's kind of in the name, right? So you're allowed to invest plan assets in the stock of the employer itself. But the main difference here is that an ESOP must, not may, must invest plan assets primarily, mainly in employer stock. Okay? So you can kind of see how a ESOP is a stock bonus plan, but a stock bonus plan is not an ESOP, kind of like that square and that rectangle thing. Okay? So stock bonuses are more of like the loose definition, right? So you can invest plan assets in the company stock if you want to with a stock bonus, but with an ESOP, it's more stringent, right? You have to invest company or plan assets in employer stock. You have to. So ESOP is have to, and stock bonus is you may. That's the main difference here to keep in mind. Participants' accounts are also stated in terms of shares of employer stock, and benefits are usually distributable in the form of stock, not just cash. And employers can actually deduct the dividends with the stocks held in the ESOP. So that's an employer benefit, basically, is they can deduct the dividends of the stocks that are held in an ESOP. All right. So I'm not going to, those are just some small details to understand the qualities. So I'm not going to repeat those. Let's move on. So let's talk about the deductible dividends. So there's some requirements. So in order to deduct these dividends that are held in the ESOPs, they must be paid in cash directly to the participants or the beneficiaries. They have to be paid to the plan and distributed in cash, right after to participants no later than 90 days after the close of the plan year. They should be used to make payments of principal and interest on any loans that were used to acquire the employer securities, or paid to the plan and reinvested in qualifying employer securities. All right, moving on. When would a stock bonus plan or ESOP be appropriate? So when a company wants to really open up the pool of ownership of its stock and create a market for it, perhaps provide some liquidity for the main shareholders' estates, or to give kind of a business continuity plan in and of itself. So we got broadening ownership of the stock, basically, creating a market, providing liquidity for other shareholders, specifically their estates, and also providing business continuity plan. And also when a company wants to give its employees a tax advantage way to get some company stock, basically. And there's an added bonus of NUA, or net unrealized appreciation, and that can't be taxed to the employee when they get the distributions from the plan. That's a huge plus. So we can talk about NUA later, but yes, that is one of the main perks of ESOPs as well. They can't be taxed when they get the distribution from the plan. It's only when they sell it. That's something very important to know as well. Moving on to defined benefit plans. So we've got the traditional pension plan first, but a defined benefit pension plan that is a qualified plan, okay? It's an employer pension, and it guarantees a specific amount of payments at retirement. So defined benefit and cash balance plans are insured by PBGC. Okay, that's really important. Let's remember that. Defined benefit and cash balance plans are insured by PBGC. When is a plan like this appropriate? It's when employers want to provide more plan contributions for the older employees. So just think about right now, the older people in our demographic most likely have pensions, while the younger ones have 401ks. And just try to remember it like that. So defined benefit, older. And also when the older employee or employees that are controlling everything, they want to maximize their tax-deferred retirement savings for their own benefit. That's the next time when you hear something along those lines, you would pick defined benefit. So we've got the Section 415 limit. Under Code Section 415, there is a max on the projected or forecasted annual benefit that a DB plan can give its plan participants. So for a benefit that starts at the age of 65, the maximum life annuity benefit is either the lesser of $265,000 for 2023 or 100% of the participants' compensation that's averaged over their 3 highest earning consecutive years. These are very important to remember. So just like that covered compensation limit where you're capped off at calculating benefits if your income goes over $330,000, this is the same thing, but on the flip side, on the benefit side, what you're getting, right? Not when you're calculating how much you're going to get, that's the 330. But if you go on the other side of the equation, that's the 265,000. Okay, that's really important to remember. That's the maximum life annuity benefit. That or 100%, and this is the lesser of, okay? That or 100% of the participants' compensation that's averaged over the last 3 highest earning consecutive years. Very important to remember that. Also important is the unit benefit formula for the plan. So this is how they calculate the benefit for a DB plan, and it's the most frequent, most commonly used formula, the unit benefit formula. It also has another name, which is the percentage of earnings per year of service formula, which is a little silly, but it describes exactly what the formula is. And the certification exam loves to throw out different names for different things. So I would be very familiar with all the possible potential nicknames that they could throw at you. So unit benefit formula, aka your percentage of earnings per year of service formula. So obviously from the name you can guess that it uses both service and salary when determining the pension benefit. You also have the final average method. Again, important to remember these methods. Using the final average method is kind of like averaging earnings over a handful of years, usually like 3 to 5 years before retirement. And that usually creates a retirement benefit that is more matched to the employee's income at retirement. Obviously, you're using an average rather than like a unit benefit formula, the unit benefit formula. But here it is, only the first $330,000 of compensation is taken into consideration. That's very, very, very important. That is your covered compensation limit. And then we got past service. So it's service with an employer that you had before they implemented the plan or created the plan. So you've been working at a company for 20 years and then all of a sudden they decide to put a defined benefit plan in. Well, that's going to kind of suck for you. So this is where it kind of comes in to save the day. This is important because if you're setting up a new plan, you want it to benefit the employees that have been servicing you for so long. For instance, it can give you 3% multiplied by the final 3 years average salary times all the service that was with the employer. So only defined benefit and cash balance plans allow for past service. Okay, so here, let's try to remember this. So defined benefit and cash balance plans are insured by PBGC, and they also allow for past service to be included. All right, so let's discuss the contributions for DB plans. So this is actually a major disadvantage. It's that the employer has to potentially put a large amount of annual funding, and they are obligated to do so, into the plan, and it must be paid whether or not the company has made a profit, whether or not things are going well. It is absolutely mandatory. Okay, so if you see someone that doesn't really want to commit to something like that, then you kind of move away from the DB plan, okay, when making recommendations. So these are the factors that sort of affect the amount that the employer contributions are, of employer contributions for DB and cash plans. So these are all factors that I think are kind of common sense. So someone's proximity to retirement age. Do you have more older or younger employees, basically? So that's going to affect, because with the younger employees, you've got a much longer time horizon. So your contributions, your mandatory contributions probably don't have to be as intensive because you have time for the market to give you some gains. But then we have past service. So if before you're considering this plan, you've had people work for you for a long time, that's something to consider as well. Forfeitures, and those actually have to be applied to reduce employer contributions. So we need to also consider forfeitures when we're thinking about the amount of employer contributions. And some investment and return assumptions, right? This is all very common sense, right? But the lower your assumptions, the more you need to contribute. The higher your assumptions, the less you need to contribute as an employer. And then lastly, the salaries of your employees and the scale at which they grow. So older employees are paid more and your younger employees are paid less, and that's going to influence how much you are contributing. Just a quick note. So employees that stick around for fewer than 1 year normally are never even included in the plan because you have that 1 year of eligibility. So think about this with all these requirements. If inflation's low, then the stock market should rise. And this increase in stock market earnings can actually decrease your company contributions. So just kind of think about it like that. All right, lastly, we have cash balance pension plans, and this is again a qualified pension plan, and it's a type of defined benefit plan, and it will usually provide for annual employer contributions, and it's at a very specific rate to hypothetical, as in not real, individual accounts. So they're not actually separate accounts, they're just kind of like hypothetical little like mental accounting buckets basically that are split up for each participant. So the employer guarantees the contribution level and additionally a minimum rate of return on the participant's account. And the cash balance plan is kind of like a money purchase plan, but money purchase plans don't involve guarantees on the rate of return. And the employer deposit can go above the $66,000 limit that's imposed on money purchase plans. So that's the big difference between cash balance pension plans. So if I see the word guarantee in there, I would think cash balance. And if I see that the employer wants to deposit more than $66,000, then I would also lean towards cash balance over money purchase. So when would a cash balance plan be appropriate is when corporations can no longer afford traditional defined benefit plans. So most often you're going to see cash benefit plans be converted. No one really just makes one from scratch. It's normally a traditional defined benefit plan that they couldn't keep up with, and they convert it to a cash balance plan. But it could also be used if the customer is just your client or whatever is just really set on receiving a guaranteed return, because defined contribution plans don't offer that. So guarantee is your big word here, but otherwise it's an option for people who chose a defined benefit plan, or companies, I guess you could say companies that chose a defined benefit plan and just couldn't afford it anymore. So they transferred over to a cash balance plan. Companies have already done this. A lot of them have amended their DB plans and converted them to cash balance plans. So almost all of the cash balance plans, like at this moment, were converted. So they're not new plans, really. All right, so what business would kind of use a cash balance plan? Mid-size or large companies, obviously they got to be like well-funded, and they're trying to just save some costs on the contributions and avoid certain rules because you're using a cash balance plan. So where it's not really perfect here is older, longer service employees are actually hurt when a defined balance plan is converted to a cash balance plan, because the lump sum payout is actually really much smaller under a cash balance formula. So your older and longer service employees are going to suffer if you do this conversion. So that is something to keep in mind. If you see that they have a lot of older employees that have been servicing a long time and they're very valuable, or the owner is like that, then a cash balance conversion would definitely not be the right answer. Lastly, we have 412I. So it is a defined benefit plan. So 412, and then in parentheses, I. This is very important to remember because it doesn't have a name that kind of explains it. It is simply a number. So 412I, it is a DB plan, and it is fully funded with insurance products. So when you see the I, think insurance. So 412I, right? The insurance company has an actuary assumption, and that becomes like the actual contribution that is due. And this plan is completely exempt from minimum funding standards. So that's a big plus. The 412I comes from the code section for fully insured plans. So this is the type of plan that only fits like very certain specific types of employees. So there has to be a need for life insurance, right? Because it's a 412I, it's for insurance, right? So there has to be a need for that. The plan does allow for a large contribution, but the plan return is just, there's no return, right? So you have to probably have an employee that's very important that just genuinely can't find some life insurance and is in desperate need of it, then, they could probably negotiate something like a 412I. It might also be referred to, I know this is ridiculous, but it might also be referred to as a 412 parentheses E, and then outside the parentheses, a 3. So 412 E3 insurance contract plan. I'm so sorry, but that is just, the way the cookie crumbles. Let's just try to memorize all this. Maybe you could see the 412. You could look at the 1 as like an I for insurance. Maybe that'll help. Memorize all those silly little names. That concludes episode 3. We continued upon our discussion of retirement plans. We discussed the solo 401k, stock bonus and ESOP plans, defined benefit plans, and cash balance plans.